Good morning, everyone. Today we are going to see the topic on admission of a partner. In a partnership concern, new partners are admitted for the benefit of the partnership firm. He is admitted either for increasing the partnership capital or for strengthening the management of the firm. Actually, during the time of admission of a partner, there is a reconstitution of the partnership firm and all the partners get into new agreement for carrying out of the business of the firm. During the time of admission of a partner, the following conditions we have to be considered. Here, when the firm is in an expansion mode and requires the plus capital. Suppose if you want to expand their business, so he needs the more capital. So during the time the partnership concern is going to admit a new partner. Suppose if he having their more knowledge, expertise in their business, so for the beneficial of the business concern, so the new partners can be admitted because of he is an expertise in this field. And also, when the partners in a question, in a person of a reputation and add goodwills of the firm, so he can be admitted as a new partner. So, what are the adjustments need to be made at the time of admission of a partner? So, actually, these are all the adjustments that we are going to make during the time of admission of a partner. So, calculating new profit sharing ratio along with the sacrificing ratio, accounting for goodwill during the time of admission partner. So, we have to calculation the value of the goodwill, and the goodwill will be shared by the old partners in that old ratio. Similarly, revaluation of assets and liabilities. It is very important for the business concern. So we have during the time of admission of a partner, we are going to revalue of our assets and liabilities of a partnership concern. And if there is any revaluation profit or a loss, it should be transferred to the old partners in that old ratio. Then they are going to bring out the admission of a capital as per the new profit sharing ratio. So these are all the adjustments we have to be considered while admission of a new partner. So the first and foremost thing is computation of new profit sharing ratio during the time of admission of a partner. So here the partners actually the new partners ratio share is given. That is the old partners sacrificing ratio is not given. Only the new partner share is given. First of all, we have to take on as the profit sharing ratio. That is the total profit we have to be considered as a one. Whether it may be he's going to earn 10,000 as a profit or 1 lakh as a profit, whatever it may be. So he is going to consider to be the profit will be one. Okay, so in this whole one part, how much of the new partner is going to get? The remaining portion only the old partners they are going to share. So like that we have to be calculate. So let us we have to be discuss the problems. So here under this method, the new partner acquires the share of future profit and losses of the firm from the old partners in their old profit sharing ratio. Old partners continue to share the balance of profits in their old profit sharing ratio. For example, A and B are in partnership concern, sharing profit and losses at the ratio of 3 is to 2. So here they admitted C as 1/5 of the partner. So for computation of new profit sharing ratio. So here I told that the new profit is considered be 1. Okay, so whatever the capital, whatever the profit, we have to be considered as a 1. Okay, firstly, we have to deduct the share offered to the new partner from 1. The new partner share is 1 by 5. So this 1 by 5 we have to deduct it from the 1. So that is the 4 by 5. So this is the remaining share. This remaining shares only the old partner is going to get. So here, second thing, they divide the balance of the share between A and B in the ratio of 3 is to 2. So 3 is to 2 is the old profit sharing ratio. So here A is equal to 4 by 5, that is the remaining part into old ratio. So here 4 by 5 into 3 by 5. So the A is going to get 12 by 25. Okay, 4 3s are 12, 5 5s are 25. So 12. 12 by 25. So the total profit is going to divide by 25. So here the A is going to get 12 portion. Then B 4 by 5 remaining part into his old ratio is 2 by 5. So 4 by 5 into 2 by 5, 8 by 25. New profit sharing ratio is A is to B is to C. So here 12 by 25, 8 by 25, and the new partner share is 1 by 5. So all the denominator is 25. So here his ratio is also we have to be converted into 25. So in this actually we are in this denomination 5. So you have to multiple by 5. So we can get 25. So the numerator also we are going to multiple by 5. So 1 into 5, 5. So 12 is to 8 is to 5. Suppose if you are going to simplify, you can simplify the ratio also. But here we couldn't simplify because it's a 12, 8 and 5. So this is the new profit ratio. So A, B and C are going to share the profit and losses in the ratio of 12 is to 8 is to 5. Can you understand? Next one, computation of new profit sharing ratio cases. The case is one when a new partner share is given, but the question is silent about the sacrificing made by the partners. In this case, it is assumed that the old partners will share the remaining share in their old profit sharing ratio. So here, that is actually we've now only we discussed the problem like this. That is A and B are the partners. The partner sharing ratio is 3 is to 2. They admit C for 1/3 share. So this is the she's new share. So here the sacrificing ratio is not given. So how we are going to calculate this new ratio? The new actually the new partner share should be deducted from 1 because we have to be, let us consider the total profit is 1. Okay, so for sharing the firm is 1. So she share 1 by 3. So the remaining profit 1 minus 1 by 3 is equal to 2 by 3. So this is the remaining part. This remaining part is going to share by A and B in the ratio of 3 is to 2. So A share 2 by 3 into 3 by 5. So 2 3s are 6, 5 3s are 15. Then we share 2 by 3 into 2 by 5. So 2 2s are 4. Then 5 3s are 15. So 4 by 15. She share 1 by 3. So all the denominators are 15. So it shall also be converted into 15. So 1 by 3 into 5 by 5. So 5 by 15. So now the new profit sharing ratio is 6 is to 4 is to 5. So this is the new profit sharing ratio. So this is the easy problem. So that is a sacrificing ratio is not given. So we have to deduct the new partner shares from one. Okay. The remaining part will be shared by the old partners. Then we are going to calculate the new profit sharing. So computation of new profit sharing ratio in case 2, when new partners purchase a share from old partners in a particular ratio, in this case, the new ratio of the old partners will be calculated by deducted the proportion given to the new partners from the share of old partners. So here A and B are these partners sharing in the ratio of 3 is to 2. They admit C as a new partner for 1/3 shares in the future profit, which he gets 1/9 from A and 2/9 from B. Calculate the new profit ratio. So here in this problem, the sacrificing ratio is given. So A sacrifice 1 by 9, B sacrifice 2 by 9 from his old share. Okay, so actually the new profit sharing ratio, old share ratio minus sacrificing ratio. So this is the formula for calculating the new profit ratio. So here A is old share 3 by 5, sacrificing ratio for C 1 by 9. So A is new share, old share minus sacrificing share. So here 3 by 5 minus 1 by 9. So 5 we have to take a common fraction. So 5 and 9 the LCM we have to take on 45. So here 5 nines are 45. So 3 nines are 27. Then 27 minus 5. So 22 by 45. So B is old share 2 by 5. B sacrifice in favor of C. So here 2 by 9. So 2 by 5 minus 2 by 9. So the common proportion is 45. So here 2 nines are 18. Then 2 fives are 10. 18 minus 10, that is 8 by 45. So C's share is 3 by 9 totally. A sacrifice 1 by 9. B sacrifice 2 by 9. So totally the share will be 3 by 9. So the denominator here is 45. So it is also be converted into 45. So 9 15s are 45. So here 9 5s are 45. So here 9 into 5 45, 3 into 5 15. So 15 by 45. So the new ratio will be 22 is to 8 is to 15. Can you all understand? So just we have to calculate the new ratio by way of deducting old share minus sacrificing share. So old minus sacrificing share. So that is considered as a new ratio. In case 3, when the old partner surrender a particular fraction of their share in favor of a new partner, in this case, following steps are followed. Determine the shares surrendered by the old partners. So, how much of the shares will be surrendered? So, it should be calculated by the business concern. Then find the new share of the old partners by deducting the shares surrendered from their old share. Calculate the share of the new partner by taking the sum of surrender share of old partners. Then we are going to calculate the new ratio. So here we are going to discuss the sum. A and B are partners sharing the profit in the ratio of 3 is to 2. They admit C as the new partner. A surrender one third of his share and B surrenders two third of his share. So actually, he is not a sacrificing, it is a surrender. So we have to be calculate first of all, how much of these shares will be sacrificed. So it should be calculated. So how will be calculated? Old share into surrender value. So like that, we are going to calculate. So for calculating their new ratio. So here, A surrender in favor of C uh, 1 by third part. So here his old ratio is 3 by 5 into 1 by 3. So if you have to multiple, so we are going to get 3 by 15. So this is the sacrificing ratio will be given by A. So now we are going to calculate the new ratio. So A's new shares equal to 3 by 5 minus 3 by 15. So here the common denominator is 15. So 5 threes are 15. So here 3 threes are 9. 9 minus 3 means 6 by 15. So B's old shares equal to 2 by 5. B surrender in favor of C is equal to 2 by 5 into 2 by 3 is equal to 4 by 15. So like that we are going to calculate. So now this is the new ratio for B. So actually we are going to calculate the C share. So he is 3 by 50. Then B is sacrifice 4 by 50. So here the new share will be 7 by 15. So the new share will be 6 is to 2 is to 7. So how much they are sacrificing by the old partners, it should be added in order to going to get their new profit, new partner share. In case 4, when the new partner secures his share entirely from any one of the partner, in this case, the sacrificing partner share is calculated by deducting his sacrifice from his old share. So here A and B are partners sharing the profit in the ratio of 3 to 2. They admit C for 1/5 share in the profit when he acquired entirely from A. So A only going to sacrifice the ratio. So it should be deducted only from the partner A. So A is old shares equal to 3 by 5. Sacrificing in favor of C is equal to 1 by 5. So A's new shares is equal to 3 by 5 minus 1 by 5. So that is the 2 by 5. So here B's share is this will be considered as the new ratio because he is not going to sacrifice any amount. So his old share will be considered as a new share. So B share is 2. Then C share is 1 by 5. So new ratio will be 2 is to 2 is to 1. So this is the calculation. Case 5, when the new partner secures a share from the old partners in a certain ratio, in this the sacrifice of each partner is deducted from their old share. So here A and B are the partners sharing the profits in the ratio of 3 is to 2. C is admitted for 1/5 share. So here, this share which he acquires A and B in the ratio of 2:1. So first of all, we have to calculate the sacrificing ratio. So this 1/5 part will be shared by A and B according to the ratio of 2:1. So 2/3, 1/3. So first of all, we have to calculate their sacrificing ratio. So A's old share 3/5. So A's sacrifice is equal to 1/5 into 2/3. So in this 1/5 part is going to sacrifice in 2/3 ratio. So we have to calculate 1 into 2, 2. So 5 into 3, 15. So 2/15. A is new share, old share minus sacrificing share. So old share is 3/5, sacrificing share is 2/15. So 7/15. B's old share is equal to 2/5. B's sacrifice is equal to 1/5 into 1/3. So it's equal to 1/15. So B's new share, to old share minus sacrificing share, 2/5 minus 1/5, 1/15 will be 5/15. C share, that is 1/5. So all the denominator is 15. So here 5 threes are 15. So 1 threes are 3. So 3/15. So the new share will be 7:5:3. Can you understand? Next one, revaluation of assets and liabilities. During the time of admission of a partner, the partnership concern is compulsorily revalue their assets and liabilities. So then only they are going to prepare their new balance sheet for during the time of admission of a new partner. So here, when a new partner is admitted into the partnership, assets are revalued and liabilities are reassessed. Revaluation account or profit and loss adjustment account is open for the purpose. Thus, account is debited with all reduction in the value of assets and increase in the liabilities, and credited with increase in the value of assets and a decrease in the value of liabilities. The difference in two sides of the account will show the profit or loss. This is transferred to the capital account of the old partners in their old profit sharing ratio. So only the old profit only they are going to share their profit or loss. That is the revaluation of profit or loss. So here, individually we are going to assess. So actually, if the asset is a reduction in the value of an asset means you have to debit the revaluation account. Revaluation account data to asset account. Individually show the decreasing value. So suppose if the liabilities is increased, it is the loss item. So you have to give the credit to their liabilities account. So here, the revaluation account data to asset account to the liabilities account. So individually which have to be increased. So with the increase in their liabilities. So this is the journal entries we are going to pass. Next one, with the increase in the value of the asset. So assets account debtor, decrease in the value of the liabilities means you have to give the debit, liabilities account debtor to revaluation account. It is the profit for the revaluation of a business concern. So assets account debtor, liabilities account debtor to revaluation account. If the asset is increased, for an example, the land and building value is 1 lakh. Now it's valued to rupees 1,50,000 means 50,000 rupees is increased. So land and building account data 50,000 to revaluation account. Suppose the liabilities, the creditors value will be decreased. Suppose the creditors is 50,000. Now the creditors value will be 30,000 means 20,000 will be decreased. So it is a profit item for the revaluation. So creditors account data to revaluation account. So like that we have to be entered under the revaluation account. Next, if the revaluation during the time of revalue their assets and liabilities, we are going to transfer the profit, revaluation profit to their partner's capital account with the profit in the old profit sharing ratio. So revaluation account debtor to capital account if it is a profit. If it is a revaluation loss, capital account debtor to revaluation account. So these entries we have to pass during the time of revaluation of assets. And now we are going to discuss about the revaluation of assets and liabilities. The following is the balance sheet of Ram and Morgan whose share profit in the ratio of 3:2 as on 1st January 2022. So here the liabilities assets is given. Trade payables 15,000, ROM's capital for 20,000, Mohan's capital 25,000, building 18,000, plant and machinery 15,000, inventories 12,000, trade receivables 10,000, bank 5,000. So totally both the assets and liabilities will be 60,000. On this date, Shyam was admitted in the following. He is to pay 25,000 as his capital and 10,000 as his share of goodwill for 1/5 of the share in the profits. So he's totally brought into the business concern 35,000. This 10,000 share of goodwill will be transferred to the old partners according to their old sharing ratio. The new profit sharing ratio will be 5:3:2. So the new profit sharing ratio will be given in this problem. So no need to calculate the new profit sharing ratio. The assets are revalued as under building 25,000, plant and machinery 12,000, inventories 12,000, trade receivables because of doubtful debts 9,500. So here it was that there was a liability for 1,500 for goods received but not recorded in the books. Give journal entries to record the above. Also give the balance sheet of the partnership firm after Shyam's admission. So now we are going to pass the journal entries for the admission of a partner. So here the Shyam brought the capital 35,000, 25,000 rupees for cash and 10,000 for the goodwill. So totally he brought into the business concern is 35,000. So bank account debtor to Shyam's capital account 35,000. So for goodwill purpose, he brought a 10,000. So this 10,000 rupees should be shared to the old partners in the old ratio. So Shyam's capital account debtor to Ram's capital account to Mohan's capital account. Then we have to revalue of our assets and liabilities. So actually the reductions in the value of an asset is 3,000. And also in order to, we have to be create the provision for doubtful debts. So it is the loss for the business concern. So it is also be reduced the value. Then trade payables will be increased 1,500. So these are all the loss items. So you have to give the debit to the revaluation account data, to plant and machinery account 3,000, to provision for doubtful debts account 500, to trade payables account 1,500. So totally 3,000 rupees you are going to record. Next one being increase in the value of building brought into the account. So 7,000 rupees is a increase in value. So it should be debited to building account debtor to revaluation account. So by way of preparing the revaluation account, there is a profit 2,000 rupees. So this profit will be shared by the old partners in their old ratio. So here a revaluation account data to Rom's capital account to Mohan's capital account. So 2,000 will be shared in their old ratio. So here 1,200 and 800. Profit sacrificing ratio, Rom old ratio minus sacrifice new ratio. So it's considered as the sacrificing ratio. So 3 by 5 minus 1 by 2 is equal to 1 by 10 is a sacrificing ratio. Mohan 2 by 5 minus 3 by 10 is equal to 1 by 10. So he is the sacrificing ratio. Then after calculating the revaluation profit, now we are going to calculate the balance sheet. So here, according to their balance sheet, the trade payables, that is the new trade payable 16,500, the capital account after adjusting the revaluation profit, the capital account of Ram is 26,200, Mohan 30,800, Shyam 25,000. Actually, the 25,000 amount only you are going to consider because the 10,000 rupees is given only for the goodwill. And assets is a building 25,000, plant and machinery 12,000, inventory is 12,000, trade receivables 10,000, less provision for doubtful debts 500, so totally 9,500. Bank balance will be 40,000, so the total of both the side is 98,500. So after admission of a partner, the capital account will be ROM is the 26,200, Mohan 30,800, and Shyam will be 25,000. So this is the new balance sheet for and the new partners, that is the Ram, Mohan and Shyam. Can you understand how to prepare the balance sheet after the admission of a new partner? Thank you.